If you're in business with other people, how do you keep track of who owns what? It's a huge question, and today we're diving into the one financial statement that answers it perfectly, the Statement of Partners' Equity. Okay, so picture this. You and two friends start a company. One partner invests a little extra cash halfway through the year, another one takes out money for personal bills. The business itself is making a profit. At the end of it all, how in the world do you figure out, down to the dollar, who owns what? Yeah, it can get messy, right? Well, the elegant answer to that whole mess is the Statement of Partners' Equity. And I love this visual because it's exactly right. It's a bridge. It takes the net income number from your income statement and uses it to build the final ownership numbers that go on your balance sheet. It's literally the scorecard that tells everyone exactly who owns what piece of the pie. So, how does this whole thing actually work? You might think it's complicated, but it's not. There are really only four things, four key moves that can change how much of the company a partner owns. Let's walk through them. All right, first things first, you gotta have a starting point. That's the beginning capital. It's just each partner's ownership value at the end of the last accounting period. So whatever their capital was on December 31st becomes the starting line on January 1st. Simple as that. Next up, we have additional investments. This is pretty straightforward. Anytime a partner decides to put more of their own money or assets into the business, their ownership stake goes up. They're literally increasing their skin in the game. Okay, this one's the exciting part. This is where the company's success pays off. The business's net income, the profit, is split up among the partners, and each person's share gets added right to their capital. Now, how it's split, well, that all comes down to what you agreed on in your partnership agreement. And the last piece of the puzzle is withdrawals. Sometimes you'll see this called drawings. And listen up, because this is a big one. When a partner takes money out for personal use, it reduces their ownership. This is not a business expense. You will never, ever see this on the income statement. It's purely a reduction of that partner's equity. So let's put it all together. The whole thing boils down to this super simple formula. For every single partner, you take their beginning capital, you add in any new investments they made, you add their share of the profits, and then you subtract whatever they took out. And voila, you get their ending capital. Okay, that's the theory, right? But seeing it in action is where it really clicks. Let's build one of these things from the ground up for a company called ABC Consulting, which has three partners, Alex, Bella, and Carlos. All right, step one, we lay down the foundation. This is where everyone stood on January 1st of 2024. You can see Alex started with the biggest piece of the pie at $180,000, while Carlos was at $120,000. This is our baseline. Now, let's see what happened during the year. We've got additional investments. Alex decided to pump in another $50,000, and Carlos added $30,000. You'll notice Bella didn't put any extra money in, so her line here is just zero. And here comes the fun part. The profits. ABC Consulting had a fantastic year and made a total net income of $285,000. Their agreement says they split everything equally, so we just take that $285K divided by 3, and each partner gets a cool $95,000 added to their capital. But, partners have to live, right? So they took some money out for personal stuff. Alex withdrew $60,000, Bella took out $45,000, and Carlos took $40,000. And see how those numbers are in parentheses? In accounting, that's just a classic way of showing that a number is being subtracted. And, drumroll please, after we do all the math, the starting balance plus the additions minus the withdrawals, this is where we land on December 31st. Alex's stake is now up to $265,000, Bella's is at $200,000, and Carlos has climbed to $205,000. This one table tells the complete financial story of their partnership for the entire year. So that was a nice, clean example. Everybody made money, everything was split equally. But what happens when things aren't so perfect? What if the business loses money, or the partners have a different kind of deal? What if the company has a bad year and loses money? Well, it's actually super simple. Instead of adding a share of profit, you're just subtracting a share of the loss. The math is exactly the same, it's just that the net income number is negative. So a bad year for the business means a direct hit to each partner's capital. And this right here, this is probably one of the most critical parts of the whole deal, the profit-sharing ratio. It's all laid out in the partnership agreement, and it does not have to be equal. Getting this figured out and written down from day one is so important for avoiding huge fights later. Just to show you how much this matters, let's imagine our partners didn't split things equally. What if they add a 5-3-2 ratio? That means Alex gets 50%, Bella gets 30, and Carlos gets 20. With that same $285,000 profit, Alex's share would skyrocket to over 142 grand, while Carlos would get way less. See? That one little clause changes everything.
Okay, so we've seen how to build it. Now let's zoom out and see where this statement fits into the grand scheme of your company's finances. Remember that bridge thing we talked about at the start? Let's see it in action.
Everything starts with your income statement. The whole process is kicked off by that one single number at the very bottom, the total net income, or net loss, for the period.
For our friends at ABC Consulting, that magic number was $285,000 in net income. This is the figure that gets handed off from the income statement, and it's the key ingredient for our statement of partners' equity.
And once our statement of partners' equity does its job, what does it give us? It gives us those final end-of-year capital balances for each partner. And where do those go? Straight on to the balance sheet under the equity section. That's the bridge, from the bottom of one statement right into the heart of another. It connects everything. All right, let's boil this all down to the absolute must-knows. If you remember nothing else, remember these 4 things. 1, you need a separate column for every single partner. 2, the formula is your new best friend. Beginning capital plus investments plus income minus withdrawals. 3, this statement is the critical bridge. And 4, say it with me, withdrawals are not expenses. So let's wrap this up with a question for you. Now that you've seen how it all works, if you were a partner in a business, what's the one thing in this whole process you'd be most careful about? Would it be making sure withdrawals are tracked properly? Or nailing down that profit-sharing ratio from the start? It's something really important to think about for anyone sharing a business.